Return on capital employed, or ROCE, is a key metric used to see how efficiently a company uses its money to generate profits. It is a fundamental financial ratio that looks past simple net income to see the bigger picture of operational efficiency. The formula divides earnings before interest and taxes by the capital the company actually has in play to run its operations. Investors use this to compare companies in asset-heavy industries like manufacturing or utilities, where managing large infrastructure is the primary business. While return on equity only looks at what shareholders put in, ROCE includes debt, giving a view of how the entire capital structure performs. Always compare ROCE within the same industry, as different business models require varying amounts of capital to function properly. A higher number is usually better, but it should always be analyzed alongside other financial health indicators like cash flow. Thanks for learning the basics of ROCE. Remember to research the full financial context before making any decisions. See you next time.